it's not a happy situation for anyone. The question is, what is happier for investors? The sponsor comes back to you and says, listen, the deal, the market has crumbled. Here's why. And I'm not, it's in the news every day. So it's not as if there's a shock here. But, this deal needs capital. And I found these folks out here, and they're willing to put it in, and it will dilute you. But good news, you can put it in yourself. Maybe you could call it, pick your poison, but it's still better than any alternative. That's the issue.
Hey there, Adam Gower here of Gower Crowd, and welcome to this episode of the Real Estate Reality Show, where we are addressing issues pertaining to distressed real estate, what's going on in the market, and talking to experts who will share with you their insights and expertise on what is going on and how to interpret it and how to protect yourself and how to, in the long run or even short run, benefit. So today, my conversation is with Mark Roderick, and I'm just pulling this thing up on the screen here. So Mark is an attorney. He is the crowdfundingattorney.com. And I saw an article that he wrote regarding how sponsors need to weave the right to raise money in addition to the original equity that they were raising in order to protect protect investor interest down the line if things go south. So I don't know, we didn't really touch on this, but to be completely candid, it does seem like that is while valid in a contract, and one of the things he talks about that you'll learn about today is the idea of preemptive rights, essentially giving investors the first right of refusal for any kind of follower need for capital, right? So if a sponsor goes out and has to raise money from a third party, at least the investors have the right to come in on the same terms. Okay, so that's fine in principle. But in reality, in a market where prices are coming down, capital is short, and sponsors are up against a debt wall, increasing expenses and inflation and reducing rents, etc., etc. At the end of the day, how realistic is it? That's what you're going to hear us talking about. My take is, yeah, all right, fine and good, but how does a sponsor actually go back to their investors saying, sorry, I've lost everything, but here's a great new deal that you can invest in to save what essentially is, to give yourself a hope note for the money that you've already invested. Anyway, it's a very interesting discussion. Mark is one of the earliest adopters, not adopters, but one of the earliest specialists in real estate crowdfunding or online syndication, I should say. He was the first person to pick up on it when Congress was debating it, and he's been tracking and commenting on it ever since. Very bright guy, and you're going to love what he has to say. And of course, don't forget, go to gowercrowd.com to see the podcast page where I'll put some links so that you can find out more about Mark and how to reach him. And also these podcasts are going out on YouTube. So if you do find them of interest, please go to YouTube, subscribe to my channel. I think it's YouTube/GowerCrowd, and comment. Please put something in the comments. That's my big thing at the moment. I would love to engage in conversation with you over there at YouTube. It's a lot of fun, and we'll see what kind of dialogues we can generate in response to these conversations that I'm having. All right, enough from me. For heaven's sake, let's get on with it. Mark Roderick, crowdfunding attorney, here he is. Mark, good to see you. Thanks so much for joining me today. I actually wrote to you to have a chat because of this post that you put on your website, crowdfundingattorney.com. What a great website. Improving legal documents in crowdfunding. Give yourself the right to raise more money. So let's talk about that in terms of what that means, not just for sponsors, but also for investors. And why don't we start at the very top? Can you kind of give me the Cliff's Notes
Yes.
for what this blog post was all about? It's just a few days old.
Yes, here is what it's all about. At the inception of a deal, the sponsor proposes a document, an operating agreement, LLC agreement, to investors that is going to govern how their marriage works. And a big question in that document, or should be, is what happens if the deal needs more money? And the point of my blog post is that, one, sponsors don't give enough attention to that question with horrid results, or they agree to things that they shouldn't agree to. And in either case, it too often and has the result that when you hit, as I said in my blog post, in April 2023, which always come along eventually, and even deals that were doing well, need more money. Now the sponsor's hands are tied if the agreement is not appropriate, and he can't raise more money, and everyone suffers. So the point of the blog post is to describe why that happens and why the sponsor must give himself the right to raise more money, and how you concurrently protect investors if the sponsor does have that right. So that's a Cliff's Note version.
Okay, perfect. So actually, let's dive down on that before we talk about how does that actually protect investors by giving sponsors the options that you've articulated in this blog post, because you talk about dilution and there's various other ways that that sponsors can incorporate that. But what the first reaction that I have to those Cliff Notes is, are we not talking about two different types of sponsor? The sponsor who is raising capital from institutional or sophisticated, family office, institutional capital, etc. They're going to get pushback on any kind of rights that they're going to hold to dilute, for example, to dilute investors in the event that more money is needed. Whereas, and this is the world that you and I met in originally. In fact, something that you pioneered, but definitely you were there at the starting gate, the world of crowdfunding. And what I've seen in crowdfunding and in crowdfunding contracts is virtual autonomy to do anything on the part of sponsors. So are we talking about two different types of contracts? Who should which audience are we talking to in this case?
Well, we're talking to both audiences, and the circumstances can be slightly different as between those two audiences, but the same thing happens. And the dangers for investors and the sponsor are the same, because all deals can go south, even if you have institutional sponsors. You certainly get more pushback from people who write big checks. And that, as you know, that is part of the trade-off as between, do you take only big checks and sort of lose control of your deal with institutional investors, or take a lot of smaller checks and maintain more control? But even in the crowdfunding space, where people are taking relatively small checks, $25,000, $50,000, $100,000, you still see plenty of LLC agreements that are either silent on this issue or say the wrong things.
Really?
So it definitely happens. And my message to sponsors is, even when you're dealing with people who are writing big checks, you just really have to push back on this hard. And I'll say that if I had written this blog post 3 years ago, maybe you and nobody else would have noticed, because that That's BS. These things don't happen. We're in this market, my only question is, am I going to get a 20% IRR or a 35%?
That's so true. Exactly.
But these things do happen.
Mm.
And so sponsors really need to push on this issue. And most of the time they don't. That's my point.
All right, so let's drill down on this. I'd like to know about what are the actual mechanisms that you talk about in the blog for raising more capital, and this specifically for the listeners or for the viewers is obviously for most people right now it is a bit too late because now we're in the depths of a collapsing market, commercial real estate market. You've already signed a contract, so go back, take a look, and refer to what Mark is about to talk about. What are those mechanisms for raising more capital?
Well, first, let me just tell you what happens in the absence of good mechanisms. What happens is that people are people, and people being people, they have different views of the world and different views of any particular situation. And this marvelous ability. Now, you British don't have this, but we Americans do. The ability to see the world through our own eyes and to think that what's good for us must be fair. So, the reason people don't put these flexibility provisions is if they say, well, if the deal needs money, everyone's going to act reasonably, and we'll come to some agreement. And the fact is, people don't act reasonably. One, people, institutional investors or non-institutional investors, may not agree with the sponsor that the deal does need more. They may say, no, the Federal Reserve is going to stop raising interest rates. This is all just a temporary blip. Things are going to get better by July. Mm-hmm. And people can have legitimate differences, but you can still reach this deadlock. And that's the worst of all possible worlds. I don't know whether you've ever heard sort of the economic theory of the prisoner's dilemma, where it would be in the interest of everyone to agree, but in the absence of a contract, they won't agree. And so they will all end up with a worse outcome. And that's what happens. In addition, you can have truly nefarious situation. For example, you may have a large investor with a lot of capital, and while it may be great for the sponsor if the deal has more money, the investor might be sitting there saying, no, you're going to run out of money, and then I'm going to make you a lowball offer to buy the property from you. Mm-hmm. So, that's not nice, but it is what happens. So now to sort of try to answer your question more, the idea is that the sponsor, no matter what kinds of equity and how much equity there is outstanding and the terms of the equity, must have the right to bring in new equity on whatever terms he can get. Because no one can predict what the market's going to look like. No one predicted 2007. No one predicted now. Well, I shouldn't say that. Some people, as you know, if you're on LinkedIn, predict the recession every month. So, once
that way they can be sure that they're right eventually.
Right. Every 10 years, they're right. But in reality, people can't predict these things. So the sponsor has to be able to raise money on whatever terms he or she can get from the market. And then you're going to turn around and say to me, well, wait a second. Now the sponsor's going to go to his aunt and uncle or his affiliated company, and he's going to raise capital on really generous terms, and it's going to dilute all the existing investors, and they're screwed. So that can't be right, Mark. And what the blog post says, the answer to that is preemptive rights. So probably your listeners know what that means, but it means that if the sponsor wants to issue new equity, he has to offer it to the existing investors first. And to tell you the truth, for institutional investors, that's pretty easy. It should be pretty easy because they have money, right? They have capital at their disposal. For crowdfunding investors or other investors, it's not so easy because if the sponsor says we need $2 million of new equity and it's going to be a preferred equity, it's going to take precedence over your existing entity. So each of, I have 200 existing investors, so that means each of you needs to put in, how much is that, 10,000 or 100,000?
Whatever it is,
yeah. And some of the investors just might not have the money,
mm-hmm.
right? They might say, crap, I'd really like to do it, I just don't have it. Mm-hmm. So in that sense, preemptive rights are imperfect. They're just the better solution than any other solution. They're the better solution than this deadlock, which hurts everyone. So the other thing, so you give people preemptive rights, you also say that the manager can't subscribe to any of the new equity until he has exhausted efforts to find third-party investors. So with preemptive rights and the inability of the manager to put the money in himself, that's as much protection as you can get, okay? And it's not perfect, but just as, Tocqueville said, I think it was him, that democracy is the worst form of government except for all the others. This arrangement is the best of possible worlds.
Okay,
so this if you took 100 deals, in some of the deals it'll work out better for the sponsor, and some deals it'll work out better for the investors. But in the aggregate, it will work out better for everyone than any other situation where the sponsor has his hands tied.
And
that's the point.
And there's no real downside except maybe an administrative one, or, well, maybe there are some downsides actually for a sponsor. Let's walk through that of offering preemptive rights. On its face, offering preemptive rights makes sense, right? That you would say, look, if we get into a situation like a lot of sponsors are getting into right now, where they are cash poor, stopping dilutions, coming up to refinances that they need more equity for. I mean, there's a whole host of reasons that deals are needing more money now. The option to whatever the source, right? It's like we need whatever sources there are. And the first stop would seem to be the people that have invested with you in the first place, no matter how embarrassing that is, to have to go back and kind of, people, I'm seeing this all the time now. People say, right, we need more money. Here's a capital call. Here are the terms of the capital calls, preemptive rights. These are the terms, etc. That's embarrassing, but not quite as embarrassing as saying, sorry, we brought in a third party that's wiped you out, right? Which is we're basically leapfrogging preemptive rights. But my question is, isn't that, it's very, very difficult. Do you not think it's, just from a practical perspective? In fact, let me ask you, have you seen it very much? And I really would like to focus on the crowdfunding world, right? So we're looking at these large syndications, hundreds of investors, specifically not institutional partners or programmatic investors in particular, but in crowdfunding investors, where the conversation from a sponsor's perspective with their existing investors is, okay, in the aggregate, you invested $2 million. So 200 of you, 10,000 each. And, we need another $2 million. So you need to come up with double. And so how do you pitch that? Your overall returns are going to go from our projected 20 IRR. I'm just pulling this out my ear, which is now 0. And instead, we're going to offer you these new terms on your new money So your average is going to be much lower. It just seems like a really difficult ask. It's new money is good money after bad. Whereas when you take that same situation to a pref equity lender or rescue capital lender, for example, you pitch it high, right? Look how big the returns are going to be. But you can't really say that to your existing investors, can you? Oh,
Sure.
look how that's the second bites at the apple. Sorry, you lost all that. Here's another great deal we've got for you.
Well, it's not a happy situation for anyone. The question is what is happier for investors? You know, the sponsor comes back to you and says, listen, the deal, the market has crumbled. Here's why. And I'm not, it's in the news every day. So it's not as if there's a shock here. But, this deal needs capital. And I found these folks out here and they're willing to put it in, and it will dilute you. But good news, you can put it in yourself. Maybe you could call it, pick your poison, but it's still better than any alternative. That's the issue. Now, the question I thought you were going to ask me, Adam.
Yes, please do.
What's the downfall of preemptive rights for the sponsor? How can it not work for the sponsor? Okay. And one answer, because there are always glitches, but one answer is that you go out to a prospective capital partner, and the capital partner says, well, I'll put in all 2 million, but I'm not putting in less than 2 million. I'm not going to share this opportunity with any of your existing investors. And they do that for whatever reason, to play hardball or whatever. So sponsors can get that pushback, and that doesn't work for preemptive right.
It doesn't work because you need to get it's like a tick. You've got to get everybody to agree and all come in at the same time.
Then you say, because if, let's say you're looking for 2 million and your existing investors will only put in 1.7, that's nothing. So there are flaws in every strategy, and you're just looking for the one that achieves the best outcome most of the time. And it's just so much better than, for example, not saying anything about it. Because if the agreement doesn't say anything about it, someone's going to sue you. You try to raise more capital, whatever you do, someone's going to sue you.
So you have to. So the point you're making is you've got to have some reference to need for capital. Is it rather, but not necessarily preemptive rights, but some mechanism for being able to raise more capital?
Yeah, I mean, you can just say we have the right to raise more capital and not even include preemptive rights. Preemptive rights are a way to protect investors. They're not for the sponsor.
Right.
And you had mentioned capital calls, and my blog post talks a little bit about that too. So the question is, well, why not just put a capital call provision in? And the answer is twofold. One, it rarely produces enough money. Even if it works. The second is, a lot of people just won't respond to it. Yeah, the agreement says I'm supposed to put in another 50 grand. Guess what? I'm not. And again, then you just don't have the money. Great, you can write nasty letters and hire a lawyer, and that and $275 gets you on the subway. And finally, including capital call provisions in your LLC agreement, particularly in the crowdfunding world, is likely to drive away investors in the first place. Most retail investors, when they make a $50,000 investment, they want to know they've made a $50,000 investment and not a higher investment. So capital calls really don't do it, in my opinion.
And what about so you've talked about equity primarily, but what about debt and taking on debt? How does that? taking on more debt? That's a little bit different in this market that we're in now. Debt is shrinking. But what about taking on more debt? In fact, actually, this kind of capital can come in the form of debt, like pref equity. It actually works like that, mez debt, etc.
Yeah, I mean, I think most agreements, the sponsor can borrow money. That would be a typical agreement. But in the climate we're in now, or that we were in 2007, that and 275 get you on the subway. There's no, the equity in the project has shrunk. The market has shrunk, and so what's happening today, as we speak, everyone who did a deal 2 or 3 years ago incurred debt that would have a balloon in 2 or 3 years, and they're all coming due now. And the problem is that the value has shrunk, so they can't refinance the whole debt. If they could, wonderful.
Well, no, even then, if they could, not so wonderful, because now suddenly it's double what it was when they started 2-3 years ago. Especially even if they had set, fixed rate for 2-3 years.
Yeah.
The world is upside down.
Yeah. So they have to get an equity cushion. That's what they need. They need an additional equity.
They need more cash
cushion.
Exactly.
And a lot of sponsors right now are going through the exercise of, can we do this? Calling their lawyer. Well, let's look at the operating agreement. Well, Mitch. Good news and bad news. So yeah, that's the situation, and it is happening. And of course, as you correctly note, we can't do anything about the agreement that was signed 2 years ago. But this is a lesson going forward of what to do and not to do in your legal documents.
All right, so let me ask you a couple of other quick questions. I want to ask you what investors should be looking for in their contracts. There's poor folk out there who have been investing in crowdfunding. Gosh, this will be so negative, but it's the reality. It's one of the conversations you and I had.
Hey, I'm an investor.
However many years ago, right? I mean, the first thing is what happens to crowdfunding when there's a downturn. So we should chat about that. But let me ask you before we do, what are you seeing in the market, Mark? I mean, what you live this world day in, day out. What's going on in the market? What is happening?
Well,
underneath the surface. Yeah.
You're probably a better market watcher than I am. Certainly the pace of the market has slowed. It hasn't stopped, but the pace has certainly slowed. And beyond that, I think people, I know from personal experience, people are just being more and more picky about what deals and interest rates, the risk of. So if you can find a deal with an existing loan that the buyer can assume at a fixed interest rate, that's a great deal, for example.
Yeah, I actually had this discussion with somebody yesterday, this exact discussion. To me, it seems like that is artificially propping up values, because even with low interest rate debt, the value of the asset has gone down. I mean, if the overall market is in decline, that's artificially propping it up. It looks good, but
I think that's right. Yeah.
But
I mean, I will just tell you that the number of phone calls that I get, that is my best market indicator, and it has been an amazingly good market indicator over my career. If I just track the number of emails and phone calls, but even 12 months ago, certainly 24 months ago, the people who called and told me that their strategy was to buy multifamily projects and install improvements and raise the rent. that, I mean, it was just a constant flow of people doing that. Those phone calls have fallen off dramatically.
Mm-hmm.
No surprise, right?
Mm-hmm. But now are those same people calling you saying, Mark, help?
No, that has not started yet.
Mm-hmm.
I have not seen um, distress situations yet. And I don't know why that is. Um, I'm sure they're out there because of all those balloon
Right.
mortgages.
Well, yeah, isn't it market lag, right? Interest rate. I mean, the impact of interest rates. But the Fed
It
just
can be,
increased.
but when you get to that balloon, that's the key.
Right.
Um, in I remember you. I think you were referring. I don't know whether before we started the recording. I was alive. I was alive and a young lawyer back in 1989,
Mm-hmm.
and during the savings and loan crisis, and that the savings and loan crisis, which was triggered in large part because of the Tax Reform Act of 1986.
Right.
Um,
Reagan.
yeah, that caused enormous distress. I mean, that just foreclosure after foreclosure after
Mm-hmm.
foreclosure. And I remember seeing tons of this situation. Sponsors needed more money.
Mm-hmm.
I have not seen it. I have not seen that so far during this cycle. I
Do you
mean, I don't
expect?
think
Do you expect to
no,
see it?
no,
Are
I
you?
don't think this cycle is anything like the things that
Well,
loan
no, not
crisis
like
was.
89 or even like '07 necessarily, but I mean, worse than, is it going to get worse before it gets better? Let's put it that
Well, I haven't checked my crystal ball since this morning.
way.
I have absolutely no idea. What do you think?
Oh, I think it's going to get bad. Yeah, I
Do
really
you
do.
really?
Yeah, I mean, I'm beginning to, so we're seeing over here, we're seeing deals getting lost to banks. They're kind of on the periphery. My sense is that this is under the surface. It's the deals that we're seeing that are going bad are like the tip of the iceberg, and that there'll be a lot of defaults. And this actually, I think, comes from this was actually my next question, and it was one of the first that you and I discussed, however many 6, 7, 8 years ago when we first met. What would be the impact on crowdfunding of online syndication of a downturn? Right. Not only do you have, and you've mentioned it, right, all this flood of new multifamily developers who suddenly discovered the wonders of buying a building, upgrading units, and making money. There's that community, but there's also this community of investors for the first time ever who have discovered real estate, had access to investing in real estate, have put their 25, 50 or 100,000 in. And I fear that the inevitability of what's going to happen is going to wipe out a lot of that money and have a tremendous, potentially a negative impact on the crowdfunding industry. And I'm being very careful when I say that. I mean, not Reg CF, I'm talking
Yes.
506C kind of crowdfunding, accredited investor type of crowdfunding. What do you think if there is a cliff that we're heading towards, will be the impact on online capital formation?
Well, a lot of people have made money. There have been real estate crowdfunding has now been around long enough for a lot of deals to have gone round trip. So people have made money. Certainly, if people are burned, they're going to be more skeptical. But I think the industry is here to stay. Now, I was surprised. I don't know whether you were, but to see Real Crowd announce recently that they're essentially selling.
Mm-hmm.
And I was disappointed. I like Real Crowd a lot. I've known Adam for Adam Hooper forever,
Yes.
great guy.
Mhm.
So I'm disappointed from an industry perspective.
Mm.
I would have hoped to have more crowd streets and real crowds rather than losing one of them.
Right.
But I
What do you
don't.
think was behind that? Any thoughts about what might be behind that? I mean, actually, they sold to a shop called Trinity or something,
Yeah,
wasn't it? Trinity or
yeah,
something, and that's a sponsor. It
yeah.
seemed that
And so
seemed
I
like
think they'll just be doing that sponsors
a
deal
brilliant
right.
play, right? I mean, how much like here we've got a whole system, a website, a whole hundred, probably tens of thousands of investors, all with a relationship. Boom! Why? No more Facebook advertising. You know what I mean? It's
Yeah.
like,
Um, I guess I'm disappointed that the industry isn't growing more. I really did think that real estate crowdfunding. I thought that by this time we would have a whole bunch of portals, that they would be geographically segmented, that they would be industry segmented. We have a portal just for New York residential real estate because it's such a gigantic market, and we'd have a portal for this and a portal for this, and it hasn't happened.
yeah,
So there you go. That shows you how much I can predict the future. But certainly, wherever the market is now, it's going to get a little deflated by the imminent losses that investors are going to incur.
Let's wrap up with the final question. So, for any investors, accredited investors, who are wondering what is happening with their investments, maybe they have, and I've been seeing this quite a lot, that distributions have been terminated. Maybe their sponsor is, not non-responsive, whatever. What should they be looking for when they open up their contracts? What should they be looking at? Bit late in the day, but what should they be looking at to understand what kind of foundation they have to stand on if things do go south?
Yeah, I mean, I think there's very little in the contract, for better or worse. This question used to be asked, well, when I invest, what should I look for? And I would always say the first thing to look for is to make sure there's no capital call provision, so that you make sure your liability is limited. But right now, if there's no equity in the project, there's nothing in the agreement that is going to either hurt or help the investor. If it's worth nothing, it's worth nothing. It's tremendously important, as you know, Adam, for sponsors to be very proactive in communicating with investors. What's going on with the project? What are we trying to do? How are we trying to make things better? How are we trying to survive? Those are always very helpful and encouraging signs for investors. If the sponsor has gone silent, that's a very bad sign, and there's probably very little that can be done about it. That's the reality.
Yeah.
Hate to end on that gloomy.
No, I know it's fairly gloomy, isn't it? But anyway, it's kind of the reality of perhaps where we are headed. We are headed into some interesting times. Your blog is absolutely fascinating. I don't think I saw it. Actually, I don't think it was the email you sent out, because I know you sent that out. You might have posted it on LinkedIn, but for anybody listening, I do recommend that you do go to crowdfundingattorney.com. That's Mark's blog, basically, and you've had that there for 100 years, actually, at least since the beginning of crowdfunding. You were one of the first people to even pick up and start commenting on it. I do remember.
Yes, I was. It's an interesting thing. It never ceases to be entertaining and challenging.
Yeah, well, we're heading in some interesting times now. Mark Roderick, crowdfunding attorney. Do you want me to mention your law firm as well? Lex Nova Law.
Lex Nova Law. But if anyone wants to find me, just go to crowdfunding attorney, or just type my name into Google, I'm not the guy who went to prison. No, I'm just kidding.
All right.
I'm
Well,
not the
good.
Mark Roderick who served time for that heinous offense so many years ago.
That's right. I know nothing about it.
I know nothing about it.
It's nice to see you, Mark. Thanks for joining
Okay.
me today.
Thank you so much, Adam. Always a pleasure.
All right, that was Mark Roderick, crowdfunding attorney, super nice guy, very bright, as you can tell, with some good ideas, and definitely somebody you want to have on your side, even if it is a teeny bit too late for the deals that you are already involved in today. That's it for this week's show. Please go to YouTube. Of course, go to gowercrowd.com, sign up to our newsletter there, where we send out a summary of all the events going on in the real estate crowdfunding world with a focus on distressed real estate at the very moment. That goes out on Wednesday's newsletter. It's free, so sign up there on the Gower Crowd website. And also, if you get a chance and you're into YouTube, go ahead and subscribe to my channel over there and comment on the podcasts as you hear them. Mark, thanks so much for joining me. I'm so sorry that I pressed the button right at the end. I was actually trying to stop the recording and I ended the meeting instead, very, very abruptly. So I apologize to you for that. That was just a little red flash, a red button in my peripheral vision that I just clicked and pop, you were gone. So anyway, sorry about that, but we'll see you again soon. And thank you also, dear listeners and viewers, if you're watching this video. Appreciate it. I hope you found that conversation with Mark of interest. And I will see you next week. For now, let me say goodbye. And for now, this is Adam Gower signing off.